You buy Bitcoin, you hold it, and you wait. But while it sits securely in your wallet, it is doing absolutely nothing. It is collecting digital dust, earning exactly zero yield. To be clear right up front, holding your private keys in cold storage is the safest, most bulletproof way to own crypto. That is the baseline. But compare that to standard fiat. Right now, cash sitting in a high-yield savings account reliably generates 3 to 4% annually. That is the risk-free expectation we have for traditional money. So what happens when a real-world expense hits and you need cash? For most crypto holders, the immediate default reaction is to execute a forced sale on a chunk of their portfolio. Look at how wealthy investors handle real estate. They don't sell off their commercial properties every time they need cash. They take out a line of credit and borrow against the equity, extracting the liquidity while keeping the asset. That exact same mechanic now exists for digital assets. You can pledge your crypto and borrow against it, but accessing that liquidity comes with distinct mechanical and security trade-offs. Deciding between selling or borrowing requires comparing the financial penalties of an immediate exit against the mechanical and custodial risks of a loan. Let's go ahead and run the exact numbers. Say you hold a $50,000 Bitcoin position and you urgently need $10,000 in liquid cash. Option A is the default choice here. You liquidate a portion of your stack to pull out the 10 grand. The exact moment that sell order clears, you trigger an immediate, guaranteed consequence, a taxable event. Depending on your holding period and income bracket, 15 to 20% of your realized gains are instantly owed to the government. This chart breaks down the second major cost. Your $10,000 position is slashed to $8,000 by taxes. As the ghosted bar shows, you permanently sacrifice the upside potential if the market runs. Buying back in later costs double your original entry price. Selling is incredibly expensive. It destroys your future earning potential and guarantees a tax penalty before the cash even hits your bank account. Now let's take a look at option B. Instead of selling, you pledge your Bitcoin as collateral on a platform like Nexo to borrow that exact $10,000. You receive the fiat liquidity you need, but you retain your position. No taxable event is triggered, and your total coin count remains exactly the same. This comparison table shows the true cost. Option A bleeds capital to taxes, while option B costs an explicit 12.9% APR. On a $10,000 loan, you pay $1,290 in interest. Crucially, the underlying Bitcoin is returned intact. All price appreciation stays yours. The mechanical restriction is simple. While your crypto is pledged as active collateral, you cannot trade, move, or sell it. When you evaluate the actual math side by side, paying a defined interest rate to a lender is frequently a much cheaper strategy than paying capital gains to the government. But borrowing introduces its own specific hazards, starting with the first major variable, the loan-to-value, or LTV ratio. This graph tracks loan health. Borrow $10,000 against $50,000, and your gauge sits safely at 20% LTV. But if collateral drops, your fixed loan becomes a larger percentage, pushing LTV higher. Reaching the danger zone triggers the automated risk engine. If you fail to deposit more crypto or pay down the cash, the system executes a mechanical consequence. It forcibly sells your digital assets at the exact bottom of the market to recover its capital. This happens because of a specific user error. People borrow the absolute maximum. They eliminate their safety buffer, guaranteeing a margin call during corrections. LTV risk is not a random threat. It is highly predictable, and you entirely neutralize it by exercising strict discipline and keeping your borrowing limits extremely conservative. Then you have to confront the existential threat. Utilizing any yield or lending product requires the complete surrender of your private keys. This is counterparty risk. You are placing blind trust in a centralized corporate entity. You are trusting their solvency, their security infrastructure, and their regulatory compliance. The 2022 crypto winter proved exactly what happens when that trust is misplaced. We watched massive, supposedly safe platforms collapse entirely. When an exchange or lending platform fails, the legal reality is harsh. Depositors instantly become unsecured creditors, and getting your digital assets returned is rare. Regardless of how regulated a platform appears to be, transferring assets out of cold storage means accepting systemic risks completely out of your control. The absolute foundational rule applies to everyone. not your keys, not your coins. Self-custody remains the mandatory default state. If your plan is to move your entire life savings onto a third-party platform just to chase a single-digit interest yield, you're taking on an unacceptably asymmetric risk. This flowchart outlines a strategy. Ask yourself, do you need fiat? Will selling trigger massive capital gains? And can you keep your LTV padded under 25%? If you answer yes to all three, collateralized borrowing is a mathematically efficient choice. Treat these platforms strictly as surgical tools. Transfer only the precise fraction of crypto necessary to secure your loan, and leave the vast majority of your wealth entirely offline. Managing a portfolio effectively requires trading one calculated risk for another to maintain a long-term position while accessing the capital needed today.